Let's bring in John Petrides, portfolio manager at Tocqueville Asset Management, now to continue this market conversation. John, always great chatting with you. So we started earnings season off pretty strong with some of the banks that reported. Last earnings season, we saw a lot of beats on those expectations. What are you expecting this time around?
Yeah, I would expect the cadence to continue to see companies outperform analyst expectations and hopefully guide for more visibility by the end of the year. You know, last year, many companies did not provide guidance for 2020 because for obvious reasons. So I'm hoping that we see that and more visibility on future cash flows. Also hoping to see that we a greater theme of returning cash to shareholders through increased buybacks, growth of dividends. However, the one potential fly in the ointment, particularly for this quarter, we could see some short-term margin pressure. Supply chain issues from because of COVID on the logistical side. We've seen a spike in commodity prices. So, those type of things could clip margins in the short term. But I do still think that with the overall global economy recovering, we're heading to easier comps year over year from an earnings standpoint, that the cadence should be continued growth, probably above analyst expectations for earnings in general.
All right, John, I want to talk to you now about some of the economic data. Retail sales rose by 9.8%. That's compared to the 6.1% that had been expected. We saw the jobless claims fall to a pandemic era low, 576,000, much better than the 700,000 that had been expected. Does this raise concerns for you over inflation, over interest rates?
Well, no, not yet. What raises concern for me in terms of interest rates and inflation is that the Fed continues to be quite dovish in its comments and policy. I mean, we saw Powell on 60 Minutes last Sunday basically say that he thinks the economy is at an inflection point. That's a bit of a different language that he used, call it a month ago at the latest FOMC meeting. So the Fed is not blinking yet, although the economic data continues to ramp higher. The Fed really views this as a transitory event as all of the stimulus has come into the economy. But the underlying economic data is proving very strong. We had the CPI data the other day, and gas and food was up 1.6%, a little bit higher than analyst expectations. And the Fed said they're comfortable with that number going above 2% and staying above 2% for quite some time. So, expect the Fed to continue their asset purchase program in the near term. And I do think, it's part of the reason of why you're seeing Treasury yields come in a little bit here, is that maybe they overshot in the short term.
I'm wondering if you think, or how you think, the Fed is going to handle that pivot. If you think that they might be forced to do that pivot perhaps even a little bit sooner than they have been indicating.
I hope not, because if the Fed has to force their quantitative tightening faster than what they hope to expect, means that they're starting to lose their grip on inflation. Inflation is getting hotter than they're expecting. And if that's the case, the Fed may have to slam on the brakes. And hopefully that doesn't the case. They have to follow the blueprint to some degree of what they did back in 2012 and 2013 when we had the first taper tantrum, and basically signal to the market that the Fed is going to be gradually unwinding its asset purchase program. And the question really is, with the amount of stimulus that the fiscal side, the government, has put into the economy, do we really need to be in crisis level monetary policy anymore? That's the big question, because the Fed is still there. And, that's what we have to wrap our heads around. And to me, the biggest risk out of all of this is not necessarily if inflation is going to run away, because I don't think ultimately it will. I do think inflation goes higher, but doesn't run away. Is the Fed setting up the market for or investors for potential asset bubbles? Liquidity is sloshing around throughout the entire economy. People are trying to find returns, and what happens is that can lead to excessive risk taking, and you could see certain bubbles pop up in certain areas. So, and maybe Archegos, the hedge fund that blew up a couple weeks ago, is the tip of the iceberg. So we have to be careful because although interest rates and easy money is a good thing to jumpstart the economy, if it's in the hands of the wrong people who don't understand risk, that could lead to some unintended consequences.
All right, let's talk portfolio allocation right now. As I'm looking on a sector basis, we are seeing tech having a nice little pop today, up 1.75 of a percentage point. On the flip side, however, and as Jared was highlighting, financials in the red, down about 0.5 percentage point. How should investors be, balancing that growth versus value debate in their own portfolios? Right. How should they manage that for the rest of the year?
Yeah, I mean, the one trigger causing this type of trade, in my opinion, is just the move in the 10-year. I mean, the 10-year is off its highs. It's come back in below 1.7%. It touched, I think, 1.78% quite recently. And when you see treasuries go up, value outperforms growth. Clearly, when interest rates rise, that benefits banks. And when treasuries come in, when the 10-year comes in, you see the reverse trade happen. Lower interest rates are good for growth stocks. Lower interest rates are bad for banks. And that's clearly the day trade that's happening, in my opinion, right now. I do think the quality of the earnings, by and large, for banks is quite good. Clearly, they over-reserved in the crisis. You can't fault them for doing that because who the heck knew where we were going to be a year ago? They were unleashing those reserves. The consumer credit portion of the bank portfolios is quite healthy. You're seeing the impact that the consumer has saved a lot of money, and the stimulus comes in and helps with that. All we need is loans on the industrial and commercial side to start kicking in, and we need the banks to have more reported time period of a steeper yield curve between the short end of bonds and the long end, which is where they clip their net interest margin. And we just need more time for that to happen. So I do think that the banks are in a good position here.
All right, John, I do want to ask you about Coinbase, about cryptocurrency. Coinbase right now up just under 1% off that reference price of $250. Is now a good time if some investors were a little bit nervous before about getting involved into crypto, especially as we have this watershed moment with that Coinbase IPO yesterday, to really start looking into adding that asset into the portfolio?
Right. Well, I don't own Coinbase. Our team doesn't own Coinbase, and I don't cover the stock, so I can't offer an opinion really on the fundamentals. But, the idea behind Coinbase makes a lot of sense. The analogy is, do you want to be the casino or the gambler? And to a degree, investing in crypto kind of seems like it's gambling because you can't really figure out what the true valuation is. No one can really tell you what, a Bitcoin is actually worth. But Coinbase is the casino where you have to, turn your chips in. So it makes it, if you are a long-term believer in cryptocurrencies and you have to use Coinbase as your exchange to turn your chip in to get cash, well, that's the casino, right? So that becomes an attractive business model. But in terms of valuation, I really can't offer an opinion on where the stock is trading today versus what its fundamentals are.
All right, John Petrides, portfolio manager at Tocqueville Asset Management. Thanks so much for joining us today.